Shane, how's it going?
Hey Kyle, long time since we did an Elevate chat. Good to see you, man.
Yeah, good to see you. It's been a while. So today's July 14th, and we're gonna hopefully make up for this break and catch up on the markets. We'll give a full overview, get into some charts, some fundamentals, and walk through your market commentary to kind of add some color there. So
Yeah,
should be good.
wrote up the commentary and posted it. What, Monday? Was it Monday? Today's Friday. I think I posted it Monday. I don't know. I don't remember, but I know it was a long one, halfway through the year. Felt like kind of a good time to take a little pit stop and take inventory of things. Although I did start it off with a few comments on how silly year to date numbers are. So
Hmm.
um, anyway, as humans, we tend to break up time into interesting but mostly arbitrary little chunks. And so halfway through a year, what does that really mean? I don't know. Not a whole lot in the grand scheme of things, but anyway, that said, we got a whole bunch of charts to run through. We're gonna do it pretty quickly. We're gonna try and keep this to 30 minutes and no longer. And I don't know if we'll even get through all the charts in that amount of time because there's a whole bunch of them. So, um, yeah, let's just hop into it, man. If you got that ready, let's see what you got on your screen.
Yep, we'll get into it here. So, and yeah, I'm gonna scroll down here just into the first chart we're gonna get at. But Shane, like you're saying, that time period idea, I think that's important, is that at the end of the day, people are trying to make money over a long time horizon, and measuring it by month to date, quarter to date, kind of gets you just lost in the weeds. And it's good to, stay focused.
You got
So,
it. Yep. Yeah, everybody's trumpeting around their year-to-date number, but if you look at the markets, they actually, can you back up 1 second?
yep.
If you look at losing say 60-40 portfolio lost 16% last year, you know, and everybody you talk to is so happy because they're up 11% this year. Well, they need 19% just to get back to even after that 16% loss. So everybody's super happy that they're up 11%. I'm just using the 60-40 as a proxy. Some people are up a little more, some people probably up less. Um, but they're still not back to even. They got their work cut out for them. The market's not back to even yet, and that's how math works. When you lose 50%, you need 100% gain to get back to even. So that's how people are, though. So yeah, if you want to go ahead and open that first sector performance chart, we can see that the 2022 sector performance on the left-hand side, the only thing that was up last year was energy, and shocker, energy down the most this year as of the end of June. So this is not through current day.
Hmm. And then Shane, going to 2023 over here, technology just kind of smoking the competition, you could say. Is there a takeaway from that? There's all this talk of, well, the top two names are leading the whole charge, or it's just the revival of the FANG names. Anything you read into that?
Uh, Markets can stay irrational. An irrational market can get even more irrational. It makes no sense at all. With interest rates being as high as they are and climbing, it doesn't actually make any sense that technology is leading the way forward, other than, if you get into the AI silliness, which is absolute silliness. Which I wrote about in my prior commentary for June. So we'll try to add links to the commentaries in the show notes so you guys can go and check those out. But no, I don't think there's any logical reason for it. It's just it is what it is. Year to date, technology's up a bunch. It wasn't down the most last year,
Hmm.
so you're here to here. So technology is like the one thing that has recovered, but the QQQ hasn't recovered. So just like the XLK has, XLK is up 40% and was down only 28%. So it's actually up over the 2 years, which is kind of weird. I mean, it caught me off guard when I noticed that. But no surprise that communications is number two. Communications was the biggest loser last year, which is where you'll find Google, for example. And Google, I think, is fairly priced, compared to some of the other mega caps. But yeah, I think AI is driving all this, and I think AI is in a massive hype cycle. So there's something called the Gartner hype cycle. We'll look at that chart next.
Yeah. And I think on this, not so alarming that the names everyone loved only 2 years ago might kind of lead the charge higher, but it's just kind of looking broadly. I want to see all these other sectors start to catch up as well. You see that breadth thrust, so that's kind of all sectors, going along with the tide. I think that's a good thing. So at least on my side, I don't have any takeaways that I say, okay, if Netflix is now at all-time highs again, that's a bad thing. But I'd like to see these names start to catch up. So,
I mean, dude, the market is in a terrible spot. I don't care what anybody says. The fact that these are up as much as they are makes no sense. Look at financials, down last year, down again. Look at staples, down last year, down again. Look at healthcare, down last year, down again this year. Utilities, down last year, down again this year. I mean, and that's a big chunk of the market. So I don't know. People are focused on just on a very, very small number of stocks in the market that are taking it higher. And that's not healthy. Nothing about the economic data is healthy. It just keeps getting worse and worse and worse as the market goes higher. So I'm very dismissive of all of it. And I don't care that technology is up 40%, and I don't care that energy is down 7.2. I don't think any of it makes a dang bit of difference. It just is what it is.
yeah.
Like, honestly, who cares? It's just a chart.
Yeah, and I think that's the power sometimes looking at a chart is you're able to trade the market you're given, not the one you want, because right now fundamentally, and with some of the moves that are going on, boy, it makes you go back to this chart, doesn't it? So this is the NASDAQ for, people looking at this for the first time, but it's 2000 through 2001. So,
Through 2002.
2002. And
That bear market was a long one.
mhm. And look at these rallies. What, up 32% early on, which not the biggest one, but what it does bear some similarities to, maybe on a different time scale, is the fact that we've had this rally back up, but we're not at all-time highs yet. So it certainly could be in the cards that, this could be that double top. Who
Well, it's
knows?
just it's all asinine, man. I mean, everybody wants to say that we're in a new bull market because the market's up 20% off of its lows. Well, if that was the case, there were three separate bull markets during the, almost 3-year down market that lost 83% in the Nasdaq back in during the dot-com bubble bursting. So, I mean, this is kind of like the mother of all bubbles that burst in 2021. To think that the market can't rally 32% before slamming down, and then rally 35% and getting slammed, and rallying 50% and getting slammed again. I mean, to say that that can't happen is it's very short-sighted. So
Mhm.
I'm not saying this will happen again, but it has happened, and it's certainly possible. So I don't know. I haven't gotten too excited about this bull market because there's absolutely no economic data to back it up. It's just prices. Feels like the meme stocks are alive again. Go buy GameStop and AMC and things that don't know how to make any money, and just hope that some greater fool comes along and buys them from you at a higher price later. That's the whole market right now. And I mean, even Nvidia is trading at 200 times earnings. It's going to take 10 years to grow into that at its current growth rates, which are high.
Yeah.
Who wants it? Like, it makes no fundamental sense to buy any of that stuff, but we got to
Yeah.
keep moving on, man.
Yep. And I think the big one there is just, yeah, the pie chart model versus being agile and managing risk is that you can ride that tide while it lifts, but you can actually get out before it just ends up being like that. So we can't predict future, but we can manage risk. And talking to fundamental, Shane, this is something you do here at Elevate on a regular basis, which is pretty robust. If you want to just kind of tell us about it and what you see.
Yeah, well, thankfully, I don't do all of the data entry anymore. We got good old Tom Damone on our team who puts all these numbers in manually. We don't get them fed in from a data source. We do our own math. We get our own data. We question data. We make sure it's accurate before we put it in here. And green is good and red is bad. So the highlighted green stuff kind of jumps off the page. We highlight anything with at least a 3% dividend as green. I don't know what happened there.
Yeah, that's weird.
Can't
All right,
can't see
back
it.
at it.
But yeah, so over 3% dividend gets green. Lower than the current market PE gets green. Forward PE, that is. Anything under 2 times price to sales gets a green highlight. Enterprise value to EBITDA Anything 12 or less, we consider good. 3-year revenue growth, anything, I think we're at 20%. Yeah, if it's above 20%, so compounded annual growth for the past 3 years over 20%, we like that. Anything with a negative growth rate gets bad, and pretty much not interested in buying it if you can't grow revenue over the past 3 years. Zillow, interesting, right? Is Zillow can't grow their revenue over 3 years because they keep losing money on trying to flip houses, which is a business they got into and out of pretty quickly, I think. But
Yep.
operating income, we don't like negative operating income, so that's bad. And then we get this no risk enterprise value, which is based on a potential interest rate. So the no risk enterprise value is how much could they afford to borrow on an interest only loan. So if just using the top row, if GPC here could borrow at a 6% rate and pay interest only using their operating income, how much could they afford to borrow? Well, they could afford to borrow 29,167,000,000 dollars. So it's a 30 billion, call it, that they could afford to just borrow the money and take themselves private. I'm not saying that they ever would, but if they could afford to borrow 29 billion at an interest only loan of 6%, but their current enterprise value is only 24.5 billion, well, the upside to that no risk EV is 19%. And I call it no risk because if they can afford to borrow enough money to take themselves private, then there's materially no difference in the risk between buying their bonds and buying their stock. So it's not that there's truly no risk at all, but if you can buy the company for less than this enterprise value, which today you can, then I think there's a very large margin of safety there. And so we just use that as our favorite kind of back of the envelope measure of valuation. And from there, we don't buy anything based on just what you see on this page. This is just what tells us where to go dig deeper. So, something that has a high growth rate, like let's say this one, high growth, but also very cheap. So this is Winnebago. So it's cheap, right? On all these valuation measures, valuation, but it also is got a green flag on the growth. There are not many others like that. Like usually it's one or the other, right? Very cheap, but not growing very much, not growing very much. So when you get a combination of the two, it has to catch your attention and say, well, geez, why is this thing so cheap when it's growing so fast? There's
Right.
another one down here, which I can't see because you're, I think, hovering still, but
There we go.
BTU, which is a coal miner, right? Growing like crazy because you gotta wonder where are those EVs getting all their electricity from? Well, it's coming from coal. And Peabody Energy, BTU, has gone bankrupt in the past 5 years, at least once, maybe twice. I don't remember. So it's growing really fast, but it's still dirt cheap. So that one has our attention. It's on our watch list right now, and we might actually buy it. Funny thing is it would fit either the growth or the value strategy. So you got to pick one, or maybe put it in both. But anyway, didn't mean to spend so much time on that, but it's a pretty cool little spreadsheet that helps us identify places to go dig deeper.
Yeah. And that's a good thing when you have a market that's just kind of running away like this, rather than just looking at price, is understanding what is the real company worth? How does it operate? So
Yep.
that's an important thing to look at. So in this one, Shane, AI, it's going to revolutionize the world, right? NVIDIA is going to go to the moon. What is this telling us?
Nobody's ever going to have to work again.
Yeah.
So this company, if you can remove your mouse there again, sorry, dude. But Gartner is the company. Oh, there he went away. You're still
There we
hovering.
go.
There you go. Gartner. You can go Google Gartner hype cycle, and you will find this on Wikipedia. And this company puts together this hype cycle for all types of new technologies, and it's pretty much the same across any new technology that comes out. Is like first the technology gets developed and it goes to the moon, and this is where you get the peak of inflated expectations, where people say stupid things like AI is gonna, you know, put everybody out of work. Nobody's going to have a job. The robots are going to control the world. We should actually be afraid of it because, you know, the robots will turn into Terminator and we're all going to die. Like that's when you know you're getting towards the peak of inflated expectations. And, you know, we're probably right about there and maybe on our way down finally. And then you'll get to the trough of disillusionment, the slope of enlightenment, and then the plateau of actual productivity. So, you know, from down here where the technology first comes out, from down here to here, you know, certainly goes up. But if you buy all your AI at the peak of inflated expectations, you may never get back there. And that's where I think Nvidia is right now, you know, like Nvidia has a long time to grow into its current valuation at even super, super high growth rates. I'm not saying it can't happen, but I'm just saying it's going to be really difficult to make money in the long run buying Nvidia at 200 plus times its forward earnings. Like that's just crazy. I don't
Yeah.
care how good the company is. It's hard to make money.
And
You want to
something,
wait and buy Nvidia down here during the trough of disillusionment when this kind of wears off and it gets down here, which will happen. And if Nvidia gets to 10 times sales from, you know, 40 times sales, you should buy it. And there's not very many companies you should consider buying at 10 times sales. Nvidia is one of them. So I'm not saying AI is useless and never going to amount to anything. I'm just saying where we are today is probably very near to that peak of inflated expectations.
yep. And it's always a good reminder. We are here now, but let's look back at one of the best tech companies out there, 1930, RCA. Can anyone tell me where that one's gone?
Does it still exist? I don't know. I
And
haven't
that's
bought
the,
an RCA equipment. You know, the other one is Cisco. So Cisco got to, you know, $83 a share or something back in 2000, and it has never gotten back there. It's 2023 now. And if you bought Cisco in 2000 at $83 a share, you're still down.
mm-hmm.
Still.
Yep. So no reason to buy on hype, you know. You can let a few things shake out, get a good opportunity and get in, but no
Yep.
need to chase.
Yep.
So,
So we got the new CPI number since then. It was down here to 3%. So this has continued to go down. But the important thing to note here is that 9.1 was the peak, right? So prior to that, it was climbing, you know, higher, and now it's going to go down. So next month, when they report CPI and for July of 2023, it's going to be versus 8.5, not 9.1. So the base effects are kicking in where the base is going to keep getting lower and lower and lower and lower and lower and lower for the next 12 months, which is going to make it harder to continue reporting this decline in CPI. So, you know, by the time we get to say June or May of next year, you know, the comp is only going to be at 4. So it's going to be harder and harder to report this disinflation because prices still aren't going down, right? We're
mhm.
not deflating. We're just not increasing prices by quite as much. So even though we're at 3% now, I guess 3% would be about right here. That's still above the Fed's target of 2%. And declining inflation means declining prices, which means declining profitability for companies in the S&P 500 and Nasdaq.
Yeah, and Shane, so if I'm hearing this correctly, what the Fed has done is they say 2% is our target, but because of the base effect, you know, we're at 4 now. This next one might only be 3.9, 3.8. It's going to get much harder to have that decreasing number. Is that correct?
Yep.
Perfect.
Yeah, the
And
one
then,
other way I was thinking of it too is like, you know, if you climb the stairs of the highest building in town, you got a lot further to fall than if you climb the stairs of the second highest building, right? And then if you
mhm,
climb the stairs of the third highest building and jump off, like there's a point where you wouldn't want to try base jumping from the building anymore because it's just not high enough, right? It's going to be very difficult to drop by enough because you haven't climbed high enough to begin with. So that's kind of something I was thinking about too, is like it's harder to drop by as much if you don't start from as high of a point.
mhm. And then now we're looking at the, you know, growth side. So inflation is everything costs a lot more. But now if wages, jobs, productivity keep up, maybe it kind of offsets, but this GDP number looks like it's coming down a little bit. What's your takeaway here?
Just that it's falling. I mean, just that the growth of GDP is dropping. So just like inflation isn't declining, it's disinflating. So it's growing by a smaller number. Our economy isn't contracting right now, but it's not growing by as much as it once was. So from 7 down to 2, right? We're still growing by 2%. It's just 2% is a lot less growth than 7%. And if you just simply look at the past 3 quarters alone, right here, we're dropping from 3.2 to 2.6 to 2, and forecasts are, for it to kind of keep falling for several quarters. Um, because a lot of demand got pulled forward during COVID. That's what caused a lot of the inflation. So credit cards are, super expensive. People are maxed out. They're doing a lot less credit card spending. If you go listen to the JP Morgan conference call from this morning, um, as consumers are still 70% of this economy. So despite the fact that the government's spending a lot more, consumers are going to spend a lot less going forward because they spend a lot already and their credit cards are maxed out. And so they've got less capacity for new spending. And when you get inflation, and you can go on to the next slide, but when you get inflation and GDP declining at the same time, that's what our friends over at Hedgeye refer to as quad four. And that's where we are right now, where if you back test it, the best asset classes are fixed income, gold, and dollars, and the worst asset classes are commodities, equities, and credit. So each one of these cycles is nuanced. It's not like you can just pick the sectors off of this list and long them and short them without worrying about, this time being a little bit unique or nuanced, right? I wouldn't say this time is different, but there's always some nuance and uniqueness to every cycle. And right now, with inflation dropping, so disinflation, and GDP growing more slowly, ultimately, what that's going to lead to is a dovish Fed. Right now, they're still hawkish, and so they're tightening in this environment, which is super abnormal. And I think that will ultimately lead to uh, a, a recession and lower stock prices, which the only way that we'll get out of that is that the Fed will stop quantitative tightening and begin to cut interest rates. But I don't see that happening for the next year or so. So I think we could be in this environment for an extended period of time. But that's where we are right now with declining inflation and GDP.
And Shane, do we know how long a cycle is? So you have four quads. Are they, are we talking 6 months, 4 years? Any
Nope.
idea?
Just until inflation starts going back up, which it might start doing soon. You don't have to click on each of these, remember, only the small ones. We can see that one pretty well. But no, there's no guaranteed time frame. It's just a matter of when does inflation start going back up and when does GDP start going back up. And the only thing that's going to cause inflation to start going back up is that it went down enough.
Mm-hmm.
And so now like I said, those base effects kicking back in might say like, 6 months from now, inflation might, we just reported 3%. All it takes is a couple of reports at 3.2 and 3.5 and 4, and now suddenly inflation is going back up, and you would no longer be in quad four. So it's a matter of the data, right? I don't have any feelings about it. There's no emotion involved. It's simple. Look at the data. What's it say? That's where you are.
Yep.
And that's how the back test works. When you go and back test which of those sectors perform the best and the worst, it's a simple objective matter of was inflation decreasing or increasing during this period, and was GDP increasing or decreasing during the period, and you test the performance and then backdate it. It's pretty simple, but very scientific and no emotion.
Yep. And here's another one. I'm sure if we back test, we'd have some interesting results, but liquidity in the markets. You got a lot of cash, it goes into assets. The Fed looks like they're pulling the punch bowl away from the party.
Yeah, well, funny thing about this is if you back tested it, you wouldn't have very much data at all. You'd only have like a week worth of data back in 1995 to even look at, and I don't think that's a good enough sample size to make any decisions. But what I would say about this one is this peak right here is what got us all the inflation that we're seeing. So that big ramp up and printing all the money, created all the inflation and, astronomical eggs and lumber prices and everything else. That created it. And so on the other side of this red line, which is kind of uncharted territory, a decline should bring down inflation, which is good, but that will bring down prices in the economy. When prices go down, that includes prices of stocks and bonds. So that's what leads us into a recession and a bear market. But this is uncharted territory. Um, the Fed doesn't want to create an inverse of this peak, so it's not going to go down by 25% because that would cause massive deflation, which is what everybody really wants. They want prices to go back down. Like we want eggs to go back to what they used to cost 3 years ago. Guess what? It ain't going to happen ever. They're never going to let it happen because when deflation shows up in an economy, people stop spending. Like if you thought that a TV you wanted to buy was going to cost $100 less next month, you would delay that purchase. If everybody delays purchases because they think prices are coming down, well, then the economy grinds to a halt and the stocks just absolutely plummet, which we did see in 2008, 2009. So while everybody wants prices to go back down, nobody wants to revisit the number of homeless people, that were created in 2008, 2009. So, this peak will not be mimicked on the downside. The Fed's they're gonna try and keep it manageable. I don't know if they can. I think it's a terrifying chart, to be honest, because nobody knows what will happen.
Mm-hmm.
And nobody knows where the level is. Like, if it was minus 10%, would that break us into deflation? I mean, we got to minus 5% and so far hasn't broke anything. So it wouldn't surprise me if they start testing it and see it come down this way. But I don't think they'll push it to minus 25%. I think that would cause, a depression of insane magnitude.
Yep.
You got a clock over there? How long we got?
I do. So we've got 5 more minutes. We're going for right at 30.
All right, let's keep rocking.
All right. 10-year government bond yield.
Yep. So this is, I'm not telling you anything you don't know. But that's pretty gnarly. The yield curve has been inverted now for over a year. This was July 5th of 2022. So we have not seen a positive spread on the 10-year yield versus the 2-year yield in over a year. And we just hit the cycle low of minus 1.08%. So that represents this gap right here between these two yields. In the past couple of weeks, we have ticked a little higher. I think we're at like minus 80 basis points right now. But I don't know about you, Kyle, but I expect the Fed to hike rates again at the end of this month, in what, I guess a week or two. Yeah, about a week and a half on the 26th of July. And if they do that, we'll probably drop again to a fresh low, which again is just a sign of an unhealthy economy.
Yep. I think we got one more left in the tank to, increase rates. And then here's just another way showing it. So,
yep. But what's important is that when it starts to revert and go positive, that's usually what signals that the recession is close, because you can see after all these inversions, rates started to tick up before the gray shaded area, right? These are recessions. So before those recessions finally did arrive, the yield curve started to uninvert or revert, however you want to say it.
yep.
And we can skip the next chart. The other one, this one's just the versus 3 months, so that's pretty nasty.
All right, we got ISM.
Ooh, don't have to click on the big ones, Kyle. But yeah, the big takeaway here, I'll just read the quote. Demand remains weak. Production is slowing due to lack of work and suppliers have capacity. There are signs of more employment reduction actions in the near term. And we just saw Microsoft do some more layoffs. So that quote pretty much says all we would want to say. And on top of that, this looks pretty ugly. Minus 46 takes us back to pandemic levels, and before that, not in the past, I think, 10 years.
Mm-hmm.
So this shows contracting manufacturing in our economy, which is again another signal of an impending recession. This one goes back 25 years, and you can see, only a couple of times in history, during the great financial crisis, during the dot-com bubble, and during COVID, have we ever been this low before. So
Yeah,
not a good sign.
no. And something just hit on quick, this dovish Fed talk. The Fed's never really lowered rates because things were good. They did it because they broke something.
Yep.
So they're still in process trying to break it. So lowering rates, it's not really a good thing that they did it. It means ISM's down, productivity, all that. So
If they cut rates, they're just going to reaccelerate the inflation. I mean, it's just
yeah.
they haven't won that battle yet. It's not where they want it to be, so they're not going to cut.
hmm And then this one, Shane, this has been the one I've kind of been looking at is market sentiment. Always like to look at that, get a gauge. A lot of people were short. Now it's kind of ripping, but what do you got here?
Yeah, I mean, just a highlight of another thing that doesn't make any sense at all. I mean, if manufacturing PMI is declining, the cyclical stocks that are responsible for that manufacturing should not be going higher. So anyway, it's just a disconnect and something to keep your eye on, but not necessarily a signal of impending doom. It's something that doesn't make any sense. And there's a
hmm
lot of things that don't make any sense about the fundamentals of this current market environment.
Today I was just flipping through charts and one that just blew me away is Nikola. I thought that they were gone. They
I
don't even
can't.
have a truck that
All,
runs.
all you got to do is push a soapbox down a hill, man, and your stock can go up 60% in a couple of days. It's just absolutely absurd.
Yeah.
Absurd.
All right, Shane, the PE, this is the valuation. Does the market make sense relative to earnings?
Yeah,
What's your takeaway there?
even on forward PE, I mean, it's not crazy expensive, but even after last year's decline, we're still not cheap. Stocks never really even got cheap. That the bottom was like 19 times. Um, and I don't know, doesn't seem to me like now is a good time to go bargain shopping. I think it's things are still expensive. Even though stock prices have come down, so have the earnings. Earnings are declining, and so it's not any cheaper. So based on every single measure, stocks are on average more expensive than they have been in the past 25 years.
Yep, not always a good sign there. And then this is the weight of the stock, something I kind of hit on earlier there.
Yeah,
Uh,
this is crazy. I mean, the I said it right here. The S&P 500 is less diversified than at any other time in history. So when people buy the S&P 500, they go buy the SPY. They think they're getting a diversified basket of 500 companies. What they're really getting is Apple and Microsoft. Yeah, 30% of their money is going into 10 stocks, and then 70% of their money is going into the other 500 stocks or the other 490. That is the least diversified it has ever been. And
yeah,
that's kind of scary. And of course, as people put money into these passive funds, the guy who runs, the portfolio manager at the passive fund shop, when he gets that additional dollar, he has to then go put more money into those top 10. It's pro-cyclical, right? It just continues creating that separation between the top 10% and the bottom 90%, a lot like income inequality in this country happens, right? It's the rich get richer, the poor get poorer, and that's what we're seeing inside of our own markets right now. I think passive funds like these ETFs are absolutely destroying the market. I don't know how it will end or when it will end, but it doesn't look good.
yeah. And I would take the opposite side in a sense of maybe these leaders are just, leading the charge out of a recession and a lower market. The other market caps will catch up. But I think the more important point is, rather than making a prediction, is the fact that if you do own the S&P 500, it's a benefit that it's market cap weighted. So in turn, had you bought, say a year or two ago, you would have a larger share of the fastest or the largest companies. So,
Yeah, but
you know,
how would the bottom of the barrel ever catch up if everybody in the world just continued to buy SPY?
and that is the question. So if everyone's just going to buy SPY, I don't have the answer to that.
It would never happen, right?
Yeah.
It would be impossible because the bigger companies would just get bigger at a faster rate, and the smaller companies would get bigger at a smaller rate, and they would just continue to separate from one another until something finally breaks. And I think that's what will happen because so much of the new money coming into the market ends up in these passive funds, and all of them got to buy Apple, and all of them got to buy Microsoft, and all of them got to buy Nvidia just because they're the biggest, not because they represent the best value, but just because they're the biggest by market cap.
Yep.
Um, and well, let's just wrap it up there. We'll leave it at this, but one of the most profound things I remember learning in the CFA program, which don't worry, I burned my CFA. I put my CFA books in a dumpster, lit it on fire, and sent it down the river back in 2021 when GameStop was the best performing stock in the in the market because the CFA books don't matter anymore. You got to have the best meme now. That's if you can make a meme, you're golden, and that's how you pick stocks these days. But I didn't forget everything I learned, and one of the coolest things that I remember learning about was called the Grossman-Stiglitz paradox. Do you remember that one?
I do not.
Well, for viewers, go check it out. Hit the Google and go Wikipedia or wherever you can find out about the Grossman-Stiglitz paradox. But basically says that if everybody the only way that there can be passive investing is if there are active managers actually out there looking at what are the best companies out there and buying the things that are the cheapest and selling the things that are the most expensive or overvalued. Like there's no other way to get an efficient market without actively doing fundamental analysis and making trades in alignment with what you're finding out, right? Like without people doing that in the market, there is no efficient market. So it's like kind of like people say, oh, the market's efficient, so there's no need for you to do that type of analysis. If the market is efficient, which I don't think it is, but if it's efficient, the only reason it would be efficient is if people were doing that work. So therefore it's called a paradox, right? And it's pretty cool to kind of think through and reason through, but that one always stuck with me. Too bad I don't think there were any questions on that in the exam. I would have nailed them, but
Yeah, I think I overlooked that one. So I don't know. Maybe you had a different year than me. I know we were close, but
yeah, it's a cool study though. So yeah, check that out, Kyle and everybody else. It's a neat thing to know about. I don't know what you guys talk about at cocktail parties, but that's probably why I don't get invited because that's the kind of stuff I would think was cool to talk about.
yeah, that's a good one. So um, we'll leave it there. Shane, thanks for joining. I'm curious to see how next week's going to go because I know today, some of these semiconductor stocks certainly looked really exciting. Those kind of did 180 into the close or coming into the close, so we'll see how that holds up. But yeah, it's always fun watching markets surprise people and try and navigate it. So
So I'm writing Kyle a Slack right now for things we're gonna put in the show notes. So we're gonna put a link to this commentary, which as you can see over here on Kyle's scroll bar, we're only got halfway through it. There's a ton more charts down here that I would encourage you to go check out and dig into. Send us questions if you have questions. We'll put an email address in the show notes. We'll put a link to this commentary. We'll put a link to the Grossman-Stiglitz paradox, and maybe even a link to the prior commentary where I hammered AI a little bit. So if we think of anything else, we'll throw them in there too. But in the meantime, that's where you'll find some links. Thanks for joining, and look forward to some questions.
sounds good. Thank you, Shane. See you soon.
Later, guys.